Stocks and bonds rally on more signs US jobs data tonight will be soft and clear the way for the Fed to cut rates. Australia's household spend-up catches the Reserve Bank of Australia's attention, and gold exports from Australia hit a record high. That's coming up in 5 Things in 5 Minutes on Friday, September the 5th. And then, in our deep dive interview, ANZ's head of Asia research, Khoon starts to analyse the impact of US tariffs on Asian economies.
No one Asian economy is gaining a significant advantage over its other competitors. Once again, the exception is India, which is at a huge comparative disadvantage because of the 50% tariff level.
But first, in 5 and 5 with ANZ, US stocks and bond prices rose overnight on more signs a soft non-farm payrolls report tonight will make it easy for the Fed to cut later this month. ADP private payrolls growth of 54,000 in August was weaker than expected, and barely half the 104,000 seen in July. Here's ANZ economist in London, Bansi Madhavani.
The headline employment data do affirm the view that the labour market is soft. Separately, the ISM services data showed that employment continued to contract in August, albeit at a slower pace. So if you look at the whole suite of data, they are indicating that the Fed will cut by 25 basis points at its upcoming meeting. Of course, the big focus is on the official labour market report, the non-farm payroll data, which released overnight. Expectations are that these data will show 75,000 jobs being added in August, and that the unemployment rate rose to 4.3%. If that is indeed the combination, it will pave the way for the Fed to cut policy rates as expected. But what if data surprises on either side? Look, a weaker than expected labour market report could add to market expectations of a possible 50 basis point rate cut. But in our view, it will take a relatively strong labour market to push the FOMC away from delivering a 25 basis point rate cut.
As of 4 a.m. Sydney Melbourne time, the S&P 500 and Nasdaq were both up 0.6% on those rate cut expectations. The yield on 10-year US Treasuries was down another 3.2 basis points at 4.179%. That's its lowest level since early May. Gold was down 1% from yesterday's new record highs, trading at $3,603 US an ounce. West Texas oil futures were also down 0.9% at $63.43 US a barrel. The US dollar index was up 0.2%. The Aussie dollar down 0.5% at 65.14 US cents. And the Kiwi was down 0.6% at 58.41 US cents. Number 2, Australian household spending got off to a solid start in the third quarter, rising 0.5% in July. That followed June quarter GDP figures showing stronger household consumption. ANZ economist Aaron Luck says the pickup has been noticed by the RBA.
Interestingly, RBA Governor Michelle Bullock actually spoke at a lecture on Wednesday, and she did mention that household consumption in the June quarter national accounts was probably a bit stronger than expected, and she also said that if this trend continues, there may not be many interest rates declines left to come. But for us, at this stage, we still think that the RBA will cut the cash rate by 25 basis points in November.
Number 3, Australia's goods trade surplus rose $1.9 billion Australian in July to $7.3 billion, its highest since February 2024. ANZ economist Sophia Angala says rural goods and resources exports were supported by higher prices, and non-monetary gold exports hit an all-time high amid global safe haven demand.
Looking broadly at the trend of the trade balance, the trade surplus has been volatile so far this year, and it's hovered between a range of $2 billion to $7.3 billion in the past year. And that's still come off its all-time peak of around $19 billion in the middle of 2022. So that downward trend there over the past couple of years has been driven by softening in export values as the commodity prices have since fallen from those peaks in early 2022.
Number 4, a key component of New Zealand's second quarter GDP, building work put in place, was slightly weaker than expected in the quarter, down 1.8%. ANZ economist Matt Galt says construction activity is 20% off its 2022 stimulus peak.
We're expecting only very gradual recovery in construction activity, including residential investment, mostly because the housing market has been quite flat. We're expecting house prices to be unchanged this year. Those aren't the kind of situations that really drive strong construction activity. So we are seeing a stabilisation in building consents as a leading indicator, suggesting that the decline's bottoming out, but we're yet to see anything that could be described as a robust recovery.
Number 5, Malaysia's central bank held rates yesterday as expected, but was more constructive with its tone, says ANZ economist Arindam Chakraborty.
They acknowledged that the conclusion of several trade negotiations has helped ease global uncertainty, which is a notable shift from earlier statements. On the domestic front, Bank Negara Malaysia expects growth to stay within its 4 to 4.8% range for 2025, supported by strong investment momentum and resilient household spending. Inflation is projected to remain moderate through 2026, thanks to easing global cost pressures. From our perspective, we expect the central bank to hold rates steady for an extended period, unless we see a significant deterioration in external demand that starts to weigh on household incomes and consumption.
Aaron Chakraborty there. Now, in our deep dive interview, ANZ Head of Asia Research, Khoon has looked at the impact of tariffs on Asian economies outside China. Now we have more details. There is one big loser, but I asked him first how things have shaken down broadly.
Now that the US tariffs against all its trading partners has been finalized, we can now start to analyze the impact on Asian economies. So far, most of the economies in Asia have landed with tariff rates of between 19 to 20%. Singapore has the lowest at 10%, with South Korea at 15%, while India has the worst reciprocal tariff rate at 50% if we include the penalty tariff rate for India purchasing oil from Russia. On the relative basis, all the Asian economies are pretty much left at their status quo relative to one another when we compare the increase in the tariff rates relative to 2024 levels. This means no one Asian economy is gaining a significant advantage over its other competitors. Once again, the exception is India, which is at a huge comparative disadvantage because of the 50% tariff level.
How important are those sectoral tariffs on semiconductors and pharmaceuticals? Because we haven't seen those yet.
Now that the reciprocal tariff rates have been finalized, we are still waiting news of the sectoral tariffs, particularly on semiconductors and pharmaceuticals, which will be important for this region. As of now, we are yet to hear what those tariff rates will be, though President Trump has indicated that semiconductor tariff rates could be as high as 100%, and he has threatened pharmaceutical tariff rates of up to 250%. If those are implemented at those rates, that could significantly impact on semiconductor exports from the region. And for pharmaceuticals, that's of vital importance for Singapore and India. At this stage, markets are not too concerned about the sector. There have been exemptions already negotiated from Taiwan and South Korea that will likely see their sectors only facing the lower agreed reciprocal tariff rate. In addition, it has been announced that TSMC will be exempt from sectoral tariffs because of the large investments they are undertaking in the US. This suggests that there is one way for companies to avoid harsh sectoral tariffs if they agree to undertake large investments in the United States.
So how much did the front-loading affect regions' economies in the June quarter, and could we see an unwind of that front-loading drag hard on growth in the September and December quarters?
Now that the reciprocal tariffs have been finalized, we are likely to see an end to front-loading activity soon. However, to date, we are still seeing very strong export numbers across the region as the front-loading activity is yet to cease. We do expect front-loading to eventually start to wane from September onwards. Now, so far, the front-loading has helped to boost Q2 GDP growth right across the region. The economy that has reported has shown stronger than expected GDP growth, and that includes India, which reported their Q2 GDP numbers on Friday, coming in at 7.8% year-on-year versus expectations of 6.7%. Going forward, however, we do expect this growth rate to slow quite significantly, particularly into Q4 and the early part of 2026, as the front-loading. At the same time, we are sensing some weakness coming through in terms of domestic demand. Policymakers are able to try and front-run this to some extent by continuing to ease monetary policy in order to help cushion the expected slowdown in growth. We've already seen Bank Indonesia cut rates recently, and we expect other central banks to continue to cut policy as well.
Khoon there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, September the 5th. Catch you next week with a review of US jobs market figures out tonight. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.